The bond didn't detonate in Washington, D.C. or Beijing. It exploded inside China's interbank market. Morgan Stanley, the fifth largest U.S. bank by assets, borrowed money last week, not in dollars, in yuan, on Chinese soil, with Chinese investors, using a Chinese system that bypasses the entire American-led financial order. Not a hedge, not a test. A $278 million yuan-denominated Panda bond, issued, cleared, and approved by the very government Trump labeled a currency manipulator. And this isn't theory. This is America's own Wall Street mutinying against its own currency. And it came hours after the U.S. Treasury admitted it was wrong. Again, net borrowing for the third quarter, revised up, not by a little, by $453 billion. Total for the quarter, $1,007 million. That's $1 trillion just to keep the machine breathing. Two headlines, one story. The dollar isn't collapsing, it's being traded around, by its own. Because as Morgan Stanley takes Yuan capital to fund offshore operations, the Federal Reserve faces a different fire. Global dollar reserves just hit 58%, the lowest since records began, down from 73% in 2001. And this isn't a temporary dip, it's a 23-year rejection. And here's the twist. It's not being led by adversaries, it's being led by allies. The top sellers of U.S. Treasuries in 2025, Japan, Switzerland, Canada. Countries that supposedly trust America the most are quietly reducing exposure to its deepest financial instrument. And they're not even hiding it. According to Bloomberg, Japanese holdings of U.S. debt dropped by $54 billion in the first half of 2025. Switzerland cut $22 billion. Even Norway trimmed 11%. But here's where it spirals. Because while America is losing buyers, China is building them. Not politically, financially. Hungary issued a 5-year Yuan bond this summer, the first of its kind from a European government. South Korea followed. Poland joined. Then came Mercedes-Benz, BMW, Volkswagen, Canada's national bank. They're not just exporting to China, they're borrowing from it. The Panda bond market has ballooned to over $15.5 billion in 2025 alone, up from $7 billion last year. And according to the Financial Times, over half the participants are now from outside Asia. The West is tapping the yuan faster than Washington can explain it. Why? Because U.S. borrowing costs are toxic. According to Moody's, the average yield for new U.S. corporate bonds exceeds 5.5%. Treasury yields have topped 4.8%. Meanwhile, Morgan Stanley borrowed in China for 1.98%. That's not just a better deal. That's a different planet. And the cause? Inflation. But not just inflation. Weaponized inflation. Because while the Fed raised rates to control prices, Trump weaponized tariffs to create new ones. Since retaking office, the average U.S. tariff rate has crossed 13%, the highest in 90 years. The logic? Punish imports. The result? Inflationary shock. The U.S. Producer Price Index for intermediate goods rose 7.1% year on year. Food inflation? Still above 5%. Gasoline? Up 5% in 6 months. And what's the backup plan? Apparently, it's to threaten the world's second largest oil producer. 10 days. That's the deadline Trump gave Russia. If no progress is made on Ukraine peace talks, the United States will sanction any country buying Russian oil. Let's pause. Because this wasn't supposed to happen. You don't burn the bridge while you're still standing on it. Yet that's exactly what happened. Trump threatened the energy supply of half the planet, while the U.S. economy is still choking on interest rate fumes. Crude prices spiked 3.5% instantly. Brent shot past $72 a barrel. And with it, inflation expectations surged. The bond market reacted immediately. 10-year yields jumped 14 basis points in a day. The Fed's forward guidance collapsed. Powell is stuck between defending the dollar or tanking the economy. He can't do both. And while the White House framed it as tough love, the market saw it differently. BlackRock's global macro strategist Ben Powell said it plainly. You don't threaten your trading partners in a fragile supply chain environment unless you're out of options. But Russia didn't blink because it doesn't need the U.S. market anymore. Not when it has India, China, Brazil, the UAE, and now, astonishingly, Japan. Reuters confirmed that Japanese refiners, despite G7 sanctions, have resumed small-scale Russian crude purchases via third-party shipping. Payments are being routed through the Mir system, settled in yuan or rupees. And India. They just signed a $45 billion long-term oil deal with Russia, bypassing SWIFT entirely. That's not defiance, that's evolution. And Washington's leverage? It's becoming bluffable. But even more devastating than lost leverage is lost belief. And the trade deal with Japan exposed just how hollow America's economic diplomacy has become. In July, Trump stood at a podium and declared a victory, a $550 billion Japanese investment in the United States. A down payment. A signing bonus. A restoration of faith. Until Tokyo corrected him. According to Japan's Ministry of Economy, Trade, and Industry, less than 2% of that deal, around $11 billion, is actual investment. The rest? Low-interest loans. Structured debt. Most not even approved yet. Worse, Trump claimed 90% of profits would go to American firms. But Japanese negotiators clarified that this only applied to certain cooperative ventures. Not the big projects. Not the infrastructure pipelines. Just the crumbs. And the punchline? Japan explicitly stated, the United States will not receive $550 billion in cash. So what did America get? A headline. And what did Japan get? Political coverage. U.S. access. A trade corridor into Mexico. That's not a deal. That's a diplomatic judo throw. Through the first 8 months of 2025, the federal government has already racked up a $1.4 trillion deficit. Add the $1 trillion the Treasury needs through September, and, well, we're on track for $2.4 trillion in red ink. That's over 8% of GDP. But here's the twist. It's not being funded by enthusiasm. Foreign buyers are thinning. Domestic funds are resisting. The Fed is on the sidelines. And yet the borrowing must go on. So rates rise. So inflation persists. So the dollar, supposedly the bedrock, keeps shaking. Meanwhile, prices keep climbing. And not just for gas or gadgets. USDA data shows beef prices are up 54% since 2022. Milk is up 23%. Eggs are up 31%. Farmers are passing on high feed, diesel, and fertilizer costs. And there's only one way to stop it: subsidize them, which Trump has already promised. But that means more borrowing, more auctions, more rate pressure, and less margin for the Fed. The feedback loop is now systemic, which is why the Morgan Stanley bond matters more than it looks. It wasn't about a rate, it was a message that America's capital elite no longer view the dollar as a given, that Chinese liquidity is safer, faster, and, most damningly, less political. And Wall Street isn't alone. In the Middle East, Saudi Arabia's Public Investment Fund issued its first yuan-denominated sukuk in July, used to fund real estate expansion in eastern China. In Europe, Crédit Agricole raised 600 million euros to buy yuan assets for cross-border settlements. The UAE central bank just opened direct yuan clearing operations. These aren't ideological statements. They're balance sheet moves, the kind that don't reverse once announced. Even India's central bank, long hesitant to rock the boat, admitted in its July monetary report that yuan reserves now make up a record 8.3% of its foreign currency holdings. This isn't de-dollarization as a threat. It's de-dollarization as default behavior. In late July, the Bank for International Settlements published a warning few in Washington acknowledged. Cross-border payments in non-dollar currencies are up 36% year on year, the largest jump since 2008. What's driving it? BICE cited systemic avoidance of dollar-linked exposure among trade-heavy economies. That includes Vietnam, the UAE, Brazil, and even Singapore. Meanwhile, Chinese cross-border interbank payment system volumes hit a record $430 billion in June, up 65% from last year. HSBC's head of Asian FX, Ronald Mann, told the Financial Times, "The yuan is now viewed not just as a hedge, but as infrastructure. And now Brazil has begun pricing soy exports to China in renminbi, a direct threat to the last reliable dollar trade bridge in agriculture." According to Brazil's central bank, over 14% of all foreign reserves are now in yuan, surpassing euro holdings for the first time in history. That's not diversification. That's a break in the dam. The world is building a plan B. Quietly, logically, in full view. And the United States, still talking like it has no competition. Still threatening trade partners. Still celebrating phantom deals. Still punishing its own consumers with structurally inflated prices. And yet, the greatest irony is this. The United States helped build the very tools now replacing it. It helped create SWIFT. It militarized sanctions. It universalized the dollar. And now, every time it pulls that trigger, another country builds around it. That's why Morgan Stanley's bond matters. Because it didn't need approval from Washington. It didn't rely on the Fed. It didn't require explaining. It just happened. Clean, efficient, final. So here we are. One American bank borrowing in yuan. One U.S. president threatening war to salvage trade leverage. $1 trillion borrowing round that nobody wants to buy. And one question nobody in Washington wants to ask. What happens when the rest of Wall Street joins Morgan Stanley? Because when your own banks trust your rival's currency more than your own, that's not de-dollarization. That's surrender. Let me know in the comments. Is this the end of dollar dominance? And if Trump's trade deals keep unraveling, who's really playing whom? We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.